Seshadri Sen joins us now, represents Alchemy Asset Management. Let's take our conversation forward with him. Seshadri, good morning. Thank you for joining us. I can see you joining us from your office. That lovely painting. When I come to your office, I just admire that painting behind your back.
Yes, it's a brilliant one. Thank you.
That's the bull, right? That's the big bull which you have at your back.
Absolutely.
Okay. Is it time to now get realistic about the risk-reward ratio? In the month of Feb and March, there was opportunity because markets had sold off. But now markets have come back. Bank Nifty is up 9% from the low, Nifty is up 5% from the recent low. Do you think the bargains in the market are missing?
Yeah, I do. I think, if you take a one-year view, we think that there's upside. Markets will largely track earnings growth, where for the Nifty at least we are at 15%, and this was the number I checked before the fourth quarter earnings started to come through, and we may see some revisions there. But yes, I don't think we are in a sustained run. It will be a volatile time for the broader markets. There is still, if you take a one-year view, there is still upside. It's not a massive upside, largely, as I said, tracking earnings growth. But, be prepared for volatility because interest rates are high. And while further hikes are unlikely, we don't think they're coming down in a hurry either.
Things be volatile. I mean, aren't all the concerns getting addressed one by one? Inflation, rupee, macros, Adani fiasco. If concerns are getting addressed, why do you think we should be in for? Why should we brace ourselves for volatility, not a clear move?
You're right, and I think that the fact that those concerns have eroded have played out in prices. But if you look at pure fundamentals and you look at earnings growth versus valuations, we are at fair point. We are neither overvalued nor undervalued. Valuations in the last 6 to 9 months have corrected significantly. So the worry that was there, say middle of last year, that India's overvalued has gone away. But neither is it like, compellingly cheap on the other side. The volatility is on the trajectory of earnings. We think that there will be a broad consumption slowdown in 2024 or in FY24 based on a high base effect, the fact that there was a lot of post-COVID front-ending in many categories, which is yet to really unwind. And therefore, discretionary demand, except for autos, continues to be challenging, and the commentary does not seem to change from whatever we've heard so far. Yes, there is upside in margins, and that is what's driving the 15% consensus earnings growth for next year. But in a situation where demand is weak, there is a risk that companies may choose to pass on those margin benefits to consumers to get more volume, and some of those margin benefits may not get realized. So on the other hand, if you look at an investable group of companies, high quality companies, valuations individually are not cheap. Some of the manufacturing companies are now trading almost like consumer companies in terms of valuation. So this is a situation which is ripe for volatility. You could see some earnings challenges, maybe not on the broader market, but individual companies' earnings upwards and downwards revisions could be fairly dramatic. And that always leads to volatility, at least at the individual stock level. So yes, meaning I don't think volatility has gone away. But you're right, from a one-year perspective, most of the concerns have receded, and therefore we remain constructive on the markets, and we think the markets will track earnings growth from here.
Okay, so you're still constructive on the market, and most of the worry you believe is out of the picture, but can't say the same about IT sector, right? There are a lot of concerns with respect to the fact that growth might slow down further. There could be a further derating of the sector. How are you approaching the IT pack? Still remain bullish?
You're absolutely right. I think between the beginning of the year and now, the situation on the IT side has changed dramatically, and that is because the smaller US banks seem to be in struggling, and therefore the demand impact from that category has impacted most of both large and small IT players. So we are cautious on the IT space. We will look at it individual stock wise. It has to be looked at from each stock has to be looked at from the perspective of three things. One, is near-term demand and the possibility, as you said, of further earnings revisions, whether that is a risk. Two, where valuations are. And in that case, on that front, many high-quality stocks have derated significantly. So, apologies. So, in that case, you will see some stocks where near-term outlook may be weak, but valuations could look compelling. And so once you combine these, one has to take an individual stock-based view. One also has to look at which segments each IT company is exposed to and take a view on that basis. I don't think the broader sector will give you a rally. If you just buy the index, I'm not sure that that's a good idea. One is to look at each individual company. And while the broader index may not do well, there could be some companies which could provide compelling returns in the next 1 year.
We spoke last time about banks. You've tracked financials for years now. Banks are in a sweet spot, but are markets pricing in FY25 and FY26 earnings also?
No, I think that's a tad unfair. With banks, what one has to brace for is that FY23 was the best year for banks in a long time. Everything went right? Margins went up, and fee income was strong, and credit costs collapsed. If you look at the next year, on a full year basis, margins will be stable to maybe slightly down. But on a quarterly basis, if you have noticed during FY23, margins sequentially went up every year. So from the exit margins in fourth quarter FY23, margins will certainly come down. Now, whether that happens in the first or the second quarter, one does not know. That is never a good thing for bank stocks. Credit costs, while this is as one banker said, an absolute sweet spot for asset quality, retail and wholesale in India. They can't come down much, not enough to impact earnings in a significant way from here. And you will find that as some of the more prudent banks are doing, even if delinquencies are low, they will continue to make provisions to shore up the balance sheet. So there's not a great deal of upside from credit costs from here. So earnings growth will be challenged. And when you're coming off such a high earnings growth in FY23, FY24 earnings growth will look a little anemic. However, valuations are not egregious at all. Valuations, if you look at a price to book basis, it's not that they are in the fours and stuff that one has to worry about derating. So the short summary is that banks will perform largely in line with earnings growth or book value compounding, and not significantly deviate from there. There will be volatility because the margin compression that we are going to see on a quarterly run rate basis could cause some volatility. But if you're looking at banks as a sector to drive outperformance, that is probably a little difficult. One has to dig deep and look at individual stocks to try and look at alpha ideas.
Seshadri, wanted to understand as well your outlook on the crude oil price movement and what the implications could be on individual sectors and for the Indian economy as well.
Well, I have a tough enough job. Forecasting crude is just adding to my stress. But meaning for whatever, I don't think that crude will spike majorly, and India has shown remarkable resilience to crude prices. So our base case is that crude remains in a narrow range, and we don't think that will cause either a major macro or a micro impact. If crude actually remains stable at current levels, within a narrow range, actually, as we get into the year, manufacturing margins will start to improve because they will benefit from passing on price hikes while raw material prices may not go up that much. Could I be wrong and there could be a major spike in crude prices? Looks unlikely in a situation where you have to look at it in a larger context where the whole world is under tight monetary policy. The Western economies are significantly slowing down. I can't see a situation where crude spikes significantly from here. But as I said, it's a tough job forecasting crude prices. But our base case is that it remains in a narrow range, and that will have limited impact on the economy and on companies.
So, if one has to understand the themes for Alchemy Asset Management for FY23 and for FY24, where are you taking outsized bets? I mean, financials, IT, those are tactical calls, but I'm sure you're taking some outsized bets where stocks which are young and you want to see them grow.
Well, I would say that, if there's one theme that I would have to pick, it is manufacturing, especially in mid caps. That is where your story is. Because we're coming out of a long winter, right? The previous decade, manufacturing went through a really, really bad cycle, right? From every angle, from top line growth to margins and down to, balance sheet stresses. And that was partly because many of the companies made bad capital allocation decisions. We are now in starting from the early part of this decade, we are now in a longish cycle of capital expenditure, manufacturing growth, relocation of manufacturing back to India in a small way. I'm not saying that's a major, but in a small way. But, that's enough delta to move the needle for many of these companies. This is not a short-term cycle. We think this is a fairly strong medium-term cycle. The nature of the sector is that most of the stocks are mid-cap. There are very few really large-cap stocks left in manufacturing, capital goods. And by manufacturing, I mean a large swathe. Even chemicals, etc., are part of our manufacturing story. The only worry is that a lot of that has been priced in. And as I said at the beginning, a lot of these companies are now trading at multiples, which are a little scary. But it's such a large universe that one can continue to dig and find stocks which have great short and long-term outlooks, but are still not, egregiously expensive. So if I had to pick one theme, it would be manufacturing, and almost by definition, that has to be played through a mid-cap to, the lower end of the large cap regime. Your ultra large caps, are fairly underrepresented in manufacturing.
Well, Seshadri, really appreciate your time. So glad you could join us with your thoughts.